Thanks for everyone who decided to attend today. So this is LEA Indirect Cost Rate Proposal Training. This will be conducted by Laura Wilson, who's on our team here. She's kind of the specialist um, for indirect costs on our team. So um, we know it's a busy time of the year right now. You got school just started, and we're probably also closing up FY25 at this time. So we decided to break this into two trainings. So we have a part one today, and then we have a part two that's going to be November 20th at 1 o'clock. So we hope you'll join us on that one as well. So today, we kind of wanted to focus on, your actual submission that you're going to submit in UPEPS. So that actuals file represents kind of the bulk of your indirect cost rate proposal. So we wanted to go over just kind of the key definitions and kind of the function codes and object codes that play into your indirect cost proposal, and kind of how those work together to create that rate that we'll use for FY 26. Actually, oh, 27, right? 27. Yeah, thanks, Laura. So yeah, this rate for this year will be for FY27. So, the part two training that we're going to do November 20th. So that'll dive more into like the adjustments. So you actually go into UPEFs and you fill out those tools for like contracts and unallowable costs. And so we'll take a deeper dive into that then. Um, some other just housekeeping items. So this meeting is being recorded, and we can send this out to you if you want that for reference, or if anyone couldn't make it, so we can share that along. There will be some time at the end for questions, but feel free if you see something on a slide or if you have a question, just go ahead and put it in the chat or raise your hand. Cody and I will be monitoring, and we can relay that to Laura. And then finally, I just wanted to point out a lot of what we're presenting on here. So we have an agreement with the feds to do the indirect cost rate proposal review. A lot of what you see here has been agreed upon with the feds. So we have an agreement with them. They've looked it over and they said, yes, we're okay with this. So a lot of that, we are working on a new one now. If there are any changes, we'll obviously let you know, but a lot of what we're presenting on is kind of what we have in agreement with the feds. So we're kind of just relaying the message there. So, anyways, yeah, that's all I have. So I'll pass it along to Laura. And yeah, thanks for everyone's attendance today.
Thanks, John. So yeah, I also want to say thank you. My thought process behind this is not to take up more of your valuable time. Hopefully we can be a help. As we've talked to people over the last year and a half, kind of floated the idea of having a little bit less formal of a training. We do talk about indirect costs in our spring and fall trainings, but those are all day and it tends to be more of a presentation lecture base. Really hoping today that even though we can't all meet together in the same physical space, we can create some synergy with questions and help us to understand better what your challenges are. Maybe as we talk to one another, we can work through some of our problems. Indirect costs can be a little bit complicated. So again, I'm Laura Wilson, School Finance Specialist here at USBE. And as John just mentioned, we are the cognizant agents for the state, the federal Department of Ed in issuing these rates. We agree on a plan. They give us that opportunity. So I'm going to give a brief overview and hope that you guys are going to have questions and comments as we go or at the end. But you're always welcome to contact any of us. If you want to dig into the CFR yourself and learn more about this fascinating topic, you can go to the Edgar section, which is 34 CFR Part 75 and 34 CFR Part 76. That's kind of where education lives in the CFR. And this talks about indirect costs specifically for restricted rate programs, typically our federal programs. However, Edgar is built on the foundation of the Uniform Grant Guidance. So we have a link for that here as well. And a lot of questions about unrestricted rates, definitions, cost allocations can be found there. So if you want to dig into this yourself, that's definitely where you can go to look. We also have Board Rule 277424, which talks about indirect costs for state programs. So we're going to just go over these basic terms. I feel like a lot of you are veterans, and this is going to be like I'm preaching to the choir. So just bear with me as we go through some of these terms. Direct costs is a term that we use. It's part of our formula. What is a direct cost? A direct cost is one that is easily allocable to a program. For instance, art supplies for the art department or teachers' salaries in a specific department. Those are clearly direct costs. They can just be put right to a program, very easily understood. Indirect costs live in our chart of accounts in our function codes 2500 and 2600, and they're the administrative overall costs that benefit the organization as a whole. So they really, I mean, you could go through and allocate a little piece of that to every single program. It's very time consuming and hard to do that. So the alternative is that we calculate indirect cost rates and you apply those rates to your programs, and then that money is used to pay for these indirect costs, which benefit the organization as a whole. This is just a little slide we got from the Department of Ed. In this house, we have 4 direct cost roommates. And specifically, the roof is going to represent our indirect costs. It equitably benefits all the roommates. So to reimburse the equitable share of administrative costs, we utilize an indirect cost rate. So there are some terms that can be a little bit confusing when we talk about indirect costs, and one of them is unallowable costs. And in this training, we're speaking to unallowable costs as defined by the feds. So an unallowable cost is a cost that cannot be directly charged to a federal program. So in specifics, what does that mean? Examples would be bad debts, judgments, entertainment, the cost of organized fundraising, lobbying. These are costs that cannot be directly charged to a program. Excuse me. However, if they create indirect costs or if they benefit from indirect costs, we will use them when we calculate your rate. They'll be put into the denominator, the modified total direct cost base. Again, we're talking about just rate calculation. Those would be used in rate calculation in our base. So to say that another way, charging these costs directly to a federal grant would be unallowable and they cannot be reimbursed. However, if they create or benefit from indirect costs, they will be included in the modified direct cost base for calculating your rates. So what is our modified total direct cost base? It is the direct costs that are obvious, like salaries for teachers, wages, benefits, supplies, and then the first $50,000 of each subaward and subcontract. This is the denominator for our formula. And we do exclude some things. We exclude things that would be distorting costs, like equipment, capital expenditures, constructions, and anything beyond that $50,000 in each subaward and subcontract. So excluded costs from the modified total direct cost base. Again, these are considered distorting costs. Like, you have a project that lasts just for a short period of time, and it would explode that direct cost pool. So we exclude those distorting costs. So when we talk about the difference between unallowed and excluded, they sound the same, but they're not. So the similarity is that neither of them can be charged directly to a federal program. However, an unallowable cost can be used in calculation of your rates by us. So this is the formula, the shining formula that we use. And we did not make this formula up. There are several formulas that could be used according to the feds to calculate indirect costs. This is the one that best fits our situation and what we do here in education. So this is the formula we use. The indirect cost pool, and this is the indirect cost pool from your data that is submitted, plus or minus any carry forward from the previous period, that is divided by the modified total direct cost base. So what causes the carry forward? Basically, when we compute your rates, as John just mentioned previously, we will calculate a rate with your 2025 data this fall. That rate will be applied in 2027. So obviously, we're applying that rate in 2027 to your 2027 numbers, but the rate was calculated based on 2025 numbers. That's the best we can do. We're making an estimate. There's always going to be a difference between what we estimate and what your actual indirect costs are. And that difference becomes the carry forward in our formula. So I think this can be helpful. If you don't understand this, or if this has made sense to you in the past, I think it's a good, it helps you to see how we flow with this formula. So if you go into UPEFs, into the indirect cost module, this is the Schedule K, and you can see for 3 periods how this is kind of working out for your LEA. So let's quickly go through. First column on the left, you can see our direct cost pool in 2020 is 287 million. The indirect cost pool is 14.9. And then the carry forward from the previous period, which is a negative number in this case, is 743. So we take the indirect cost pool, we subtract the carry forward, and this total number here, this 14.1, that is the numerator that we're going to use in our formula. So this 14.172790 is divided by our direct cost base, the 287 and 744, and we come up with the rate, 4.93 in this case. So when you move one column to the right in 2022, we're going to apply this rate to 2022's numbers. You can see in 2022, our cost pools have changed. That's always going to happen, right? And so we subtract again our carry forward from the indirect cost pool. Here are our totals now. So when you drop down further in this column, our actual direct costs, we multiply our 4.93% times our 2022 actual direct costs. So this calculated recovery of 16,122,427, that's what we've recovered in 2022 based on the rate we calculated in 2020. Your actual indirect cost pool, however, as you can see from up here above, the total indirect cost pool is less than that, 15,785,546. When you subtract the actual cost pool from what you recovered, the calculated recovery, this difference, which in this case is an over recovery, we recovered a little bit too much, this difference becomes our carry forward in the next period. So you move again, one column to the right, and you can see the carry forward is now a negative 336,881. That's because we over recovered. So now when we calculate the rate moving forward, we are subtracting that over recovery from our indirect cost pool. And we go through the same process. We come up with a new rate, 4.95. That is going to be applied, as you can see, in 2024. And I mean, for those of you who've been around indirect costs at all, you understand that we have 2 completely separate sets of data for indirect costs. We have odd years and even years. So if you have questions about that, feel free to ask. So common questions that we get every year. Why is my rate fluctuating so much? And to be honest, when we get these questions, we always look at your specific LEA. We do hand calculations to be sure that our back end UPES calculations are working correctly. We want to make sure that there hasn't been some kind of something happen that's messed that up. But almost always, I would say 90% of the time, these rate fluctuations are data issues. And those are primarily from, first of all, changes in cost pool numbers. And secondly, changes in the way that perhaps we have been classifying contracts so that that contract adjustment in UPEFs has varied. These are where we see um, some of the reasons for that. So this is an example of how a cost pool change can affect your rate. And this is data from an actual LEA that I pulled out of UPEFs. You can see that between 2022 and 2024, there's a large increase in their direct cost pool. And then their indirect cost pool, which is here in gray, is a substantial decline. So you've got your denominator getting quite a bit larger and your numerator getting quite a bit smaller. And when that happens, we take the rate that we initially calculated, we apply it to those new cost pools, and we now have a much larger carry forward than we had in our previous period. And you can see a huge drop in the rate from 4.95 to 0.45. So always when I talk to people about these things, I ask them to just look closely at your data. Just be sure that you have coded them the way that they should be coded. Sometimes there are legitimate events that happen and they do cause our cost pools to fluctuate, and that it is what it is. I mean, we need to reflect what actually happened here in our data, but also sometimes we've just miscategorized things. And so if we can do our best to be sure that those categorizations, how we're coding things, are correct, it will help a lot. Another thing to recognize is that because of the carry forward nature of this formula, once the rates get really wonky, it doesn't correct itself the next period. Like, it's going to take a few iterations of that loop for it to kind of normalize and come back to the middle. So again, another reason to just really, really be sure that the way that we're coding our data is an accurate reflection of what has actually happened during the year. So I wanted to talk a little bit about the contract piece. And this is a rubric that we got from the feds that is to help us classify our contracts. So when we think about the contracts that we're going to enter into the UPEF's contracts tool, these are only contracts for direct costs. Any contract that you have that is for something that would be considered indirect is just an indirect cost. It goes into the indirect cost pool. So these direct cost contracts, you will want to look at them and decide if they qualify as a subaward or a subcontract. And if they do, we want those to be entered into the contract adjustment tab in UPEFs. If it qualifies as a professional service, for instance, you might hire a speech pathologist that works with a few students. As you go through that contract and you compare it to this rubric, if you feel that that's a professional service, then it's just going to go completely, that entire expenditure will go completely into your direct cost pool. You do not enter it as an adjustment if it's a professional service or a pass through. Also, this rubric was put out before recent changes. So you can see down at the bottom where I have these highlighted bright yellow. The exclusions here are listed as $25,000 exclusions with contracts. That's because that used to be the number. And this rubric is a little bit older. It's now a $50,000 exclusion. So to just kind of talk a little further about contracts, when you are trying to decide whether a contract should be entered as an adjustment in the UPEF's contract tab, should contracts for anything that is a professional service or an indirect cost be entered in that contracts tab? The answer is a no. And also, it is important to realize that the things that you enter into that tab, the contracts that you enter, the subcontracts and subawards, the first $50,000 of that contract, what will happen is that first 50,000 will be put in the denominator of our formula. So it doesn't matter if it's a $2 million contract or a $75,000 contract. Only the first 50,000 are going to be put into our denominator. And that's because the idea behind that is that when we contract out services rather than doing them in-house, just less of an administrative burden on the LEA. So contracts can be a little bit tricky, but again, it's really key that we try to keep this consistent. So I often suggest to people that you have a separate workbook where you have all the contracts that you have at your LEA listed, and then how you have classified it according to this rubric, and possibly some notes as to why. And then next year, if you are not the person doing indirect costs, or if you have more than one person involved in this process, they can easily see why you've done what you've done and hopefully keep it consistent. These contracts can have a big effect on the denominator of the formula. So if you see big fluctuations in that, again, you'll see your rates bouncing all around. So it's best to keep that just as consistent as we can. Okay, now this, I reached out to a specific LEA here in the state, talked with them through their journal entry process, and I don't say that this is exactly the process that all of you do, probably something similar. And for those of you who may be struggling a little bit with the journal entries, I thought I would put this in here as an explanation or a talking point, however we feel. So in this instance, we're going to assume that we have a restricted rate of 5.01% and that we have eligible program expenses of $100. In this case, the program we're talking about is SPED. So because that 5.01% has been entered into Utah grants will automatically add $5.01 to the program expenditures for the LEA. So the LEA will be reimbursed for the full $105.01. So for your journal entry, you will recognize the full $105.01 in revenue. And then the $100 in expenses, that was already recognized within the program. So this next entry records the $5.01 of indirect costs in SPED. So you can see their fund function and object. This is an expenditure. The program is the difference here. So the first entry for the expenditure is a debit for 501 to the SPED program. And then the credit is also an expenditure, but it's a credit entry, and it will go to program 9999. So I think different LEAs record this with different programs. They have a different, like just a holding kind of program for their indirect costs. So your 870 objects, which are the indirect cost objects, you now have these canceling each other out. And the reason that we do this is so that we don't double count the expenditure. So in other programs, we've already paid for, the lights or the custodial or whatever it is. This entry, then the program 9999 will flow through onto your APR into that first column. And so this way we can keep track of what we have, where specifically we're getting our reimbursements for indirect costs, but we don't double count. So if you have any questions or comments about that, we'd love to hear them. These are the references that we commonly use in addition to the CFR. These are, some of them are a little bit easier to use than others. They're recommended by the Department of Ed. It can be a confusing topic. Sometimes it seems like they contradict each other. You have to dig in a little bit to see how they relate. We would just definitely recommend any of these references, as well as us. We can be your reference. So we'd love to hear from you. We would love to hear what your challenges are, what your questions are, confusion. What can we help with?
Ara, this is Jamie at Jordan. How are you?
Great. Hi, Jamie.
Hey, just one frustration that I have been seeing over the last couple years is it seems that more and more programs are adding to their board rule that indirect costs are not allowed to be charged against their program. And it's really frustrating when purchasing, HR, payroll, accounting, right? So many departments that are part of the indirect cost pool, but then can't be charged against the program, although all of those departments have some hand in making that program function each year. And I don't know if it's a not understanding how indirect cost works and why we have it and why we charge it to have an explanation to the USBE programs, but it is frustrating that every year, oh, now this is changed from unrestricted to restricted, or now it's changed from you can charge to now you can't charge. And I see a dwindling of the ability to charge indirect cost to programs when our effort from all of these outside departments to help said program keeps increasing each year. And I'm sure, I don't know if there's anything you can do, but it's just a frustration that we see at our district. And I'm sure other districts are probably seeing that too. So just for what it's worth, if that's a discussion you could have with program people and how I know it's really easy to have them just put in a line in a board rule that says, you know what, indirect costs can't be charged. But I don't know if they really understand the theory and the logic behind indirect costs and how those costs really do benefit the program, because if it wasn't for all of those other departments helping said program, that program wouldn't function. So for what it's worth, that's my 2 cents. Thank you.
For sure. Yeah, that's frustrating because it's definitely true that all those programs benefit from the administrative costs, right? To keep the lights on, to do the accounting, to do all those things, they definitely benefit from that. Are you talking about specifically state programs that you're seeing that more in, or federal programs?
More, I would say, state than anything. It is frustrating. Some have changed from restricted to unrestricted, and some have changed from being able to not being able to. And it could change mid-year. We get a rule change that says, oh, just kidding, starting next year you can't do it anymore. So and I just don't know if it's not understanding the functionality of indirect cost at a programmatic level. And because all I hear, especially when I was at USBE, was, well, you're taking money away from kids and programs. And it's like, I understand that. However, do you understand that all the people behind the scenes are what's helping not only the program people, but all these departments that have people in them that are working behind the scenes also help function to get this program off the ground and running daily. And I think that's one of the frustrating things is I don't know if they're understanding it's not just the programmatic person who's implementing the program. It's many hands that are making sure that that program and, in essence, benefiting the kiddos and down the line. And I just think it's that I would like, I don't know how you can communicate that, but that is one frustrating thing I've seen.
We can pass that along. I can't speak to who makes that. I don't know exactly who makes that into call. I don't know, but we can definitely share that frustration and that feeling in meetings so that that's put forward for sure.
Hey,
Thank
and
you.
Jamie, do you think that list is growing over time, or is it like, do you think it's getting more examples of like what you said there?
For programs to not allow indirect costs to be charged, yes, I
Yeah.
think it has grown over the time.
Okay.
Definitely. Because when I was at USB, right, we would have programs come up to us and say, oh, I don't want to charge indirect costs. And I'm like, well, you can't make that decision. We have an agreement with the LEA. They have the ability to charge indirect costs. They can't pick and choose programs to charge it against. And so then you find out the next year that said program person went to a legislature or went to, the administration at USB and got it written into their rule that you can't charge it. So, right. So it's a roundabout way of forcing I understand, right? They want the money to go to the kiddos. I get it. But at the same time, right, and I see that grow as soon as someone's figured out, oh, I just need it in a board rule, and then they can't charge it. And so I see that process every time we get a new program, it seems, or they don't like something being charged for indirect costs, that they're like, oh, well, I'll just put it in the board rule next year, and then you can't do it. So
Yeah.
I have seen that increase.
Okay, so I'm wondering, so we do have some documentation we're working on. Some of that is just kind of the theory of indirect costs. So hopefully that may help with some of these things. Like, why is it out there? Even though it may not feel like it, like your programs and all programs kind of benefit from these. But maybe we could do an internal training as well, just to our program staff, maybe our board. As far as we do manage that list on this team, but the default is with state programs that the unrestricted rate can be charged. So unless we see a board rule that says no, or there's some of the state like stipends and stuff like I think they're put unallowable on there, and sometimes in statute we see a provision that'll say you cannot charge indirect costs, or you can charge 5% admin only, and everything else is kind of restricted. And so unless we see those things, we kind of leave it unrestricted, but it does sound like those things are growing. So um yeah, I appreciate that comment.
I appreciate that too, John. And I think a lot of, or I won't say a lot, but I have noticed an increase. Well, this money is only supposed to be used for payroll, or this money is only supposed to be used for stipends, right? And so therefore you can't charge indirect costs. And I'm like, well, that's not really how it works. And I still have to have a payroll department and an HR department to process all those things and set it up, and accounting to do the transactions. So all of those still cost money in order for your program to function. And I think that's just maybe clarification, and a teaching moment for all the program staff at USBE would be great. So I appreciate that. Thank you.
Thanks, Jamie.
Yeah, Jamie, really appreciate that too. I actually have some time on our leadership council agenda here at USBE next month, actually. And I was kind of looking for a topic, so that's going to be one of them. So hopefully I get some program specialists paying attention, um, and we can cover indirect costs a little bit. So really appreciate it.
And it looks like we got a couple comments in the chat that are agreeing as well. Looks like that's kind of growing there. So yeah, definitely something we'll be mindful of. And um, yeah, um, let us know if there are any other questions. We still have, we kind of, we've got plenty of time here. We had this scheduled for 1 hour. It's 1:33. So um, feel free to put something in the chat. For now, I'll just say definitely pay attention to especially the function codes 2500s and the 2600. So those are the main parts of your indirect cost rate proposal. So we scheduled this training here before the October 1 UPEF's actual submission for this reason. It is something that we check, and we do look at these function codes from your audited statements as well to make sure, what we see in UPETs kind of matches what the financial statements show. But definitely check that. The actual indirect cost rate proposal is not due until the end of December. So the CFR mandates December 30th, or 6 months after the end of the fiscal year is when you need to submit those. But USBE has the due date at December 15th. So a couple weeks before that federal due date, just to make sure everybody's in. So yeah, the proposal itself is due December 15th. The almost 90% of it is from your actuals file that you'll submit in October here. Um,
I'm
and
curious if are there any LEAs here who have not used an indirect cost rate in the past? Like I'm curious if LEAs are trying to understand if it would benefit them to use an indirect cost rate, or if the people who are, in this space are more like, yeah, we've done this for a lot of years, but we have these questions and these frustrations. Is there anybody in the meeting that has not in the past used an indirect cost rate? No. Okay, interesting.
Looks like there is one. Um, Nicole Laird. I haven't been using it, and I'm trying to figure out if I should.
We're just a small one-off LEA. So like
Okay.
I am the business office, I am the indirect cost. So I've been trying to decide if it's worth it for me because we're just so small and just trying to figure out the ins and outs of it. So I'm a fairly new business manager as well. So
Well, feel free to reach out to us anytime, and we'd be happy to talk to you about, you know, like go through your programs and help you see, like, if you've got this much money in your program expenditures, how much money you get back to help with all these administrative light type of expenditures. We'd be happy to help you. It is a
awesome.
very complicated subject. So
Thank you.
Um, on that note, what I will say is your required October 1 submission is probably 90% of your proposal. So most of it's already done. And you also don't have to charge the full rate if you don't want to. So you do have options. You can not charge indirect costs at all, even if you have a rate negotiated. So, but I do think it'd be worthwhile to actually put some numbers on paper and see if it is worth it. Sometimes it's not, and I understand that.
and if you decide that you would like to do that, but not the full amount, that perhaps we calculate a 14% unrestricted rate for you. If you really feel like that's too much, you can decide you only want to charge 8 or 9% or whatever you choose. But it does have to be that percentage across the board on all your programs that are unrestricted. You can't say, well, for this program, I'd really like to only take 9%. For this one, I want the 14. It does have to be consistent. And if you would let us know if you choose to apply a rate that is different than the one that's calculated.
All right.
That's the only caveat there.
Laura, is there a fix in Utah grants for that if you use a different rate than what they calculate?
Well, so if we know, then the rate that gets put into Utah grants is the one that you're going to use. But if you don't tell us, we would put in the rate that was calculated.
Okay, thank you.
Yeah. Mm-hmm.
Laura, I've got
Yeah.
a question. Someone asked about their unrestricted indirect cost type funding. They gave me a hypothetical. Let's say our charter school received 25 PQHA funding for $5,000. The school's indirect cost rate was 17.3% for prior year. Do I need a journal entry for $865 for unrestricted / non-restricted direct costs? Is that correct?
I'm sorry. I'm going to need to read. I need to
So,
read that question again. Sorry.
They have $5,000 in unrestricted indirect cost type funding. Their rate is 17.3%. Does he need a journal entry? I'm guessing for $865. Let me do the math real quick to make sure it's right.
So your indirect cost rate is applied to the expenditures in the program, not the revenue. So you might be given a grant for $5 million and you only expend 100,000. The indirect cost rate is applied to the money you spent, to the expenditure for that year. Does that make sense?
Okay. I'm sure he'll message me back shortly if he has more
I don't know
questions.
I don't
on
know if
that.
I answered that correctly or if I understood it
He
correctly.
says that makes sense.
Okay, good.
I can take the next one. USIMS. Wondering if USIM system will function similar to UPEFs when entering the information. So, yeah.
We're hoping.
Yeah,
Fingers
USIMS
crossed.
is to be determined. When we are building USIMS, we're trying to take the good and leave the bad. There are some shortfalls of the UPEF's indirect cost rate proposal module. So, will it be similar? Yes, absolutely. I think what will remain is the, 90% will be done upon that initial actual transfer. Um, you know, the chart of accounts don't always get the unallowable and excluded things just right. So there's always going to be some sort of module or adjustment section. But we definitely are making an effort to pair those modules with documentation. So we are trying to be better about that and trainings. So um, it may not be exactly the same, but it will be similar. A lot of what we've built is based on the CFR and some requirements in there. And you know, we also just kind of copy what other states are doing, and that's what the feds are used to, and they'll come look at it and approve it. And so when that will be done is nobody knows, but we are
And
trying to.
we're in meetings all the time, like
Yeah.
weekly, going over, and we're really heavily involved in the USIMS indirect cost module right now. And we meet with the USIMS team, our team does. And then there's also a second meeting weekly or bi-weekly where the USIMS team is trying to reach out to LEAs and say, does this make sense to you? Is this helpful to you? We're really trying hard at this point to have something built that's going to be useful and convenient. We're hoping to make things more convenient, not less.
And that said, we do have working groups for USIMS, and we do encourage and we would love LEA participation in those. So we are kind of at a point where we're still getting going with just getting the data into USIMS. So we're not quite to the indirect cost rate proposal, but I think once we get to that point, I would love to have some more LEA feedback in those groups. What should we enter here and what should we leave out, and things like that. So if you're interested and have time for that, just let us know and we'll invite you to those USIMS meetings. So, um, next question, I see Thomas, custom class, new charter school. Do we need to apply for indirect costs if we're not opening until August of 2026?
No.
Um, so our proposal's based on having a full year of actuals. So we use your actuals to calculate the rate. So until we have a full operating year, you'll have to use, I think you're able to use the de minimis rate, which is just a kind of a set rate before you get one. And I'll verify with that. But so yeah, I wrote that down. I'll actually reach out about that. So
Another point with that, when you're in your pre-operational year, although you do have some revenues and expenditures, they're much lower than they will be in your operational year. And even between your first operational year and your second, there may be quite a bit of growth. And so, go back a few slides where we were talking about what happens to your rates when there are huge jumps or dips in your cost pools. It can be very disadvantageous to you to establish an indirect cost rate in a pre-operational year and then start applying those rates moving forward. When you become operational, you do see huge changes in your cost pools, and sometimes it can make your rates weird. So I mean, you can look at it and run the numbers, but I think it might be more advantageous to you to use the de minimis rate initially until you have cost pools that are going to be kind of more in line with each other moving forward.
okay, thanks,
We,
Laura.
we've got another question from Rodrigo. I think you're in Uinta district, if I remember. He's asking if there's a specific object or function code that they should use for federal grants, because they share grants with other districts and the funds flow through them. Do we have specific objects or functions for those, John? I would need to pull up the chart of accounts and do probably a deeper dive.
Yeah, and I think, is this related to the CTE fiscal agent that you're on? I think this might be.
Yes, yes, it is.
Okay. Yeah, I'm with Cody. Let me look into that. Um, however, I do know for pass-through type funds, in regard to the indirect cost rate proposal, is those get excluded from the calculation. So even if they're listed as an expenditure, they're excluded um, from the calculation itself. And I think the reason being distorting, or I guess the theory is just passing funds through like that. You don't need the administrative help like the purchasing, the HR, the IT support, even though it's always there a little bit, obviously. But I think as far as this training indirect costs, we do exclude those. So,
Yeah,
uh,
Are
no,
they
I get
excluded in
that
the
they need.
application, John?
well, I'm guessing it's in the coding, so I'll just have to get the chart account coding. Yeah.
Yeah.
John, it's Neil at Box Elder. I have the same issue out here. We're the fiscal agent for 3 other districts with ourselves for the federal program. I'm thinking
Okay.
maybe we should exclude the other awards as a sub-award since they all flow through us, and that should take care of that amount. And then
Yeah.
whatever we book as indirect costs for our own district, we leave in there. Because there's not an object code for it. There's only 816, 870 on object codes.
Okay. So yeah, um yeah, let me look into this, and yeah, we'll get back to you on the flow through.
Yeah, it would
I
just
do
be
know it
nice
should be
if
excluded.
it'd be nice if we had something, a way that it just kind of flagged that or identified that and pulled that out because, I mean, we're running them through very similar programs and it's just difficult to parse things out at times. But if we can record it a certain way and have your system pull it out, that'd be great.
Okay. Yeah, let me look into that. And Neil Boxelder, you said similar situation. Fiscal agent pass through
We're the passer for 3 other LEAs for Perkins.
Perkins. Okay, yeah, gotcha. Thank you. So I'm not seeing any more questions, but if you think of anything, or if there's something you want us to address in the next training, or if you just, feel free to email us at any time. And especially during the indirect cost rate proposal itself or during your actual upload. That's kind of what we're here for. So we may not have the answer right away, but we'll definitely look into it and get back to you. So,
And we are at our desks. I mean, we live in this weird virtual community world, but we are here. So, we also have phones. As weird as it is, if you call us, we can pick up the phone as well. So feel free.
And don't be afraid to leave a voicemail because, if we don't pick up, we will listen to that voicemail and we will get back to you.
I'd ask
Absolutely.
one quick question is, I don't see much difference between a professional service provider and a contract that's excluded. Is there much difference there I'm missing?
So I would encourage you to look at that rubric because it does make some very specific differences. And also, if you look in the Department of Ed, there's a reference to this in the previous slide. The Department of Ed put out a cost allocation guide, and some people ask questions about specific types of contracts. Would this be considered a contract or a professional service? And it will kind of break those down for you so you can see the differences. But that is, I mean, this isn't coming from us. They want you to differentiate between a subcontract subaward or a professional service. And you can, if you kind of dig into that rubric, I can go back if you'd like, and we can look at it in
Sure.
detail. Let me go back. Let me find it.
And
Okay.
I will send this presentation out via email too. So you guys can look at this rubric via the PowerPoint that you get.
So if you look at the top row here in this rubric, a subaward is for the purpose of carrying out a portion of a federal award, and it creates a federal assistance relationship. A subcontract is for the purpose of obtaining goods and services for a non-federal entity's own use, and it creates a procurement relationship. The professional service, these are professional and consultant services rendered by persons who are members of a particular profession or possess. What just happened to me? I'm black. I just went all black.
Are you still there, Laura?
I can see her. Her screen, sharing screen went away.
Huh.
No,
Seems
she's
to be
frozen.
having technical difficulties. Well,
Sorry.
uh,
Screen just went black because I hadn't been tapping on him for a while, I guess.
ah,
Sorry. Let me take you back to the slide. I apologize for that. Okay. Nope, wrong one. This one. Sorry, I'm trying to not have you have to look at my sidebar here. Well, anyway, sorry, we're going to look at the sidebar too. But as you can see,
Laura, you'll have to hit share screen again.
oh, sorry. Okay. Sorry, guys. Share screen 3. Share. Can you see it? Can you see my screen 3?
Yeah,
can now.
you're good, Laura.
Perfect. Sorry about the sidebar you're going to see, but as you can see, the professional service cost of a professional or consultant service rendered by persons who are members of a particular profession or possess a special skill, and they are not officers or employees of the non-federal entity. That means the LEA. Okay, so then you can go down through here and it'll tell you to determine the allowability of the costs, to consider these things: the past pattern of costs, the necessity of contracting for the service. Those things will help you decide how to categorize that. Sorry, Neil, this was like totally convoluted to get to this, but if you can look through this rubric and then consider it with your contracts, and like I said, this is a judgment call. Like, we are just going to absolutely believe you when you say, I mean, well, if I get something that comes through in your entry that looks really weird, I may reach out and ask you about it. But we want you to make the judgment call. You're the one who understands these contracts, right? And how they should be classified. But again, once you make that decision of where to put it as a professional service or a subcontract, I would keep some notes on that so that whoever's doing it next year can look at them.
Okay.
Does anybody else have any questions?
We'll send this rubric out as well. It's kind of small here in the slide, so we'll just include it as an attachment. But this
It's
is kind of
also a reference at the end. It's referenced in our
oh,
reference.
okay, great, perfect. Thanks, Laura. Okay, well, I'm not seeing any more questions, so I think we could end here. Just as a reminder and a save the date, and I'm gonna put this in the chat, our part 2 to this training, and we'll take a deeper dive, especially in things like this, like the contracts module. So that next one, Thursday, November 20th, 1 p.m. We hope to see you there. We'll send out some reminders before then. But yeah, thanks for attending. And
Can
yeah.
I say one more thing? I'm sorry,
Oh,
John.
sure. Yeah.
If you, between now and the next training, if you do have a question that is recurring and you would like to see it discussed, if you, when you get the invitation to that meeting, respond back and say, hey, could we cover this? I specifically think this would be beneficial. We would love that. We'd like to not waste your time by covering things you don't maybe really need to hear. So if there's something you would like to see specifically discussed, please let us know.
Thanks, Laura.
Okay.
Agree.
Well, with that, I will end the recording.
Thanks, Cody. Thanks, everyone.
Thanks, everybody.
Thank you.
Yeah.